Good morning. My name is Larry Ripka, the CEO of the Valmark Financial Group. It's been a little while since I've done my last podcast, but today I'd like to talk about what I call the Great Call. It's how new upcoming GAAP accounting rules impact the life insurance companies and products that we offer to clients. In a game of poker, players bet on the cards that they have in their hand against other players. And through the course of the game, they have several rounds of betting. They can hold their cards, not make further bets. They can fold, push their cards into the middle and abandon their bets. But at some point, there's a call. And when the point in the game is reached with a call, players have to put their cards face up. The bet is calculated and there are winners and losers. Using this metaphor, the U.S. life insurance industry is now at a stage of what I call the great call on products sold several years ago. We're seeing announcements, particularly from public companies, but also from mutual companies, and they're signaling whether they are going to fold or continue to play. The long-term nature of life and annuity contracts really means that we don't know the financial bet that they've made on these products until well in the future. The sale of a company provides a reconciliation of that bet. If the company sells for less than book value, then the bet was a losing one. But it's only at that time that we really know the gain or loss or how much. The Financial Accounting Standards Boards, or FASB, changed the rules on how companies account for particularly reserves on long-dated life and annuity contracts. And this change will now go into effect in 2023. It was pushed back some. This change, combined with really the dramatic drop in bond yields, has brought about what I'm calling the Great Call. Under these new rules, companies will have to account for where they are on products that they sold many years ago. Now, in some of my past posts, I've commented on several transactions involving U.S. life insurance companies and what they mean for policyholders. Most of these transactions have resulted in very large losses. In fact, since 2008, I am aware of only 3 transactions involving life insurance companies that sold for more than their book value. So just in the last couple of weeks, Allstate announced the final financial results on the sale of its life and annuity businesses. It had sold the majority of its non-New York businesses to Blackstone, but just recently announced the sale of its New York life and annuity subsidiary to Wilton Reinsurance. Interestingly, the New York regulators required that Allstate post $600 billion more of assets in the company before they sold it. And they ended up selling it for $200 million. Think about having to put $600,000 into a house that you are then selling for $200,000 is a way of thinking about it. So these were clearly losing bets. And when we put these 2 transactions together, it was a total loss of $4 billion, exceeding the $3 billion in sales proceeds that they received. Now, there's a lot of attention and focus on the publicly held companies, but last couple of weeks, we also had an announcement by a major mutual company. Ohio National Life announced that it agreed to be acquired by Constellation Insurance Holdings. This is a PE-owned firm funded by 2 Canadian pension plans. The transaction will take the form of a sponsored demutualization with whole life policyholders or some whole life policyholders receiving cash for their interest in the company. But in addition, Constellation will shore up Ohio National's balance sheet with an investment of $500 million of additional capital over the next 4 years. For those who have been observing, Ohio National had sold large amounts of both variable annuities with long-term guarantees and universal life with secondary guarantees. Both of these are very surplus intensive products. And as interest rates have dropped, this bet has certainly not played out for Ohio National. At the time these products were sold, the company used what I would characterize as rented capital to maintain its ratios for state insurance regulatory purposes. This capital mainly took the form of captive reinsurance. Now, when using these structures, ultimately the financial results play out, and that is what happened. Now, the company had been attempting to right the ship on these blocks of business by ceasing to pay trails on the variable annuities, but also laying off a third of their home office workforce. But this wasn't enough, and they needed additional capital. Ohio National will no longer be a mutual company. Those investors are going to want returns on what they paid to the shareholders for the company and the additional capital. So we can expect real pressure on the non-guaranteed elements of products issued by Ohio National in the months and years to come. Fortunately, it will put an additional capital cushion to protect policyholders, but this really cannot be viewed as good news. The Ohio National announcement shows that it's not just stock companies that are facing trouble, but all companies. The bets that the mutual companies make on products are often just less visible because we don't see a decline in share prices. We don't have the benefit of SEC filed statements quarterly. I really recommend a post that Bobby Samuelson did on this subject in the Life Product Review. It really gives you some great insight into how this happened and how this may play out with other companies that have made similar bets. For those who follow the life industry closely, none of this should come as a surprise. A version of this poker game has been going on with life companies for at least 25 years. At the time, the companies argued that the economic reserves needed for products like the ones I've mentioned would be far less than the statutory reserves. And there was an ongoing debate with insurance regulators, insurance company executives, the rating agencies, and FASB about how these should be accounted for. Now, as we talk about statutory and economic reserves, both of these are really based on several factors that actuaries project many years into the future when they build a life insurance product. Another way of thinking about reserves is to think of them as a sinking fund to pay off future claims. Reserves are calculated based on a number of things, most importantly, an interest rate assumption on what companies will earn, but also levels of claims paid out when policyholders might access certain benefits, and policyholder behavior. How many people will keep this policy? How many people will surrender it? How many people will use certain riders even? Well, I've been following this for about the last 15 years. And 15 years ago, I wrote an article entitled Guesses, Promises, and Guarantees. In that article, I took data provided by the Fitch rating services about some of these things. At the time, they warned that if interest rates and other factors played out unfavorably, insurance companies could need to post another $50 to $100 billion of capital for universal life with secondary guarantees. I ended up doing a presentation at the AALU meeting with Jeff Moreweiser, senior actuary at Fitch Rating Agencies. And in our meeting, we modeled a policy for a male age 55, $1 million with $12,000 of annual premium. Now, the assumptions being used at the time by the carriers for economic reserves showed that they would have a $17,000 net present value gain on issuing a policy of this time. Now, he also modeled what would happen if interest rates fell, if mortality was worse, or if those policies persisted at a greater rate. And in that model, he outlined a set of circumstances that could lead to a net present value loss on that single policy of $100,000. As we fast forward and look at those policies today in 2021, it's a lot closer to the $100,000 loss than it is to any profit. Colin Devine, who was the leading sell-side analyst with Citigroup following the life insurance industry for a long time, once observed that pricing mistakes last forever. It just has taken a long time for some of these mistakes to show up. And previous versions of GAAP accounting rules allowed insurance companies to book profits on more favorable assumptions. And this includes products like universal life with secondary guarantees, long-term care insurance, and certain annuities with lifetime benefits. The consistent and persistent decline of bond yields and mortgage yields is the main thing that is causing these bets to be losing bets and bringing about the great call. If we were viewing the participants of the life insurance industry as players in the poker game today, we can see carriers like Allstate, Great West, and Voya who have folded. They've taken their lumps, and we can quantify the level of loss. We have a smaller number of carriers that have strong balance sheets and maybe have avoided some of these pricing mistakes or avoided them to some extent. And I've outlined previously how 10 companies in the last 12 months have raised over $20 billion in new capital and debt on very favorable terms that I've outlined on the screen. A third option that we see besides folding or increasing a bet is companies moving capital-intensive products into a stock spinoff. Think about this as passing the cards, chips, and markers to another hand. This has been the route taken by Bright House, AXA with Equitable, and the one recently announced by AIG and Jackson National with their U.S. entities. In this situation, there is no current reconciliation on the bet. Under the new GAAP accounting rules, these spin-off entities will have to account for the reserves on these products starting in 2023. So as insurance professionals think about what insurance companies they should recommend to their clients, they really need to think about what category do the life insurance companies fit in. Are these companies that have folded and have a thinner capital base? Are these companies that have increased their bet and demonstrated an ongoing commitment to the U.S. life insurance industry? Are these companies ones that have passed their chip, continue to play, but often with a lesser capital base? Or are they companies that we just still don't know what is in their hand? I think we can, with thought, really divide all insurance companies into one of those four camps. Second question that I think insurance producers should be asking is, which form of products best protect my clients as there's these financial pressures and as they come due? Will companies that had losing bets on long-term care seek to claw back some of that from policy benefits of other forms of products where they can alter it? So really looking for product types that allow the insurance companies to make less adjustments to our policyholders. If we look at this today, we look at products that provide a combination of guarantees based on a separate account chassis. We call them variable hybrid products, especially in the death benefit market, are products that offer not only good value for policyholders, but long-term alignment for the companies that are going to stay in the insurance game. It really allows the client to have a guaranteed premium, some upside based on equity performance, but it keeps them aligned with a product that can be profitable and sustainable for the insurance for the long haul. Well, that really concludes my post for today. Thanks for listening. At Valmark Financial Group, we bring the golden rule to life. Thank you.